Whole life insurance for your kids. A legal disclaimer we put at the beginning of all of our presentations. This information is for general and educational use only. Content is not intended to substitute for professional, legal, or clinical advice. We try to keep our information as accurate and timely as possible, but make no promises and guarantees it works for your local unique situation. As an introduction, few people know about whole life insurance. We're very familiar with term life insurance. It's cheaper, it's short term. You can get it for a year, 5 years, 10 years, 20 years. And it's like renting a house. You either die during that time and your family gets paid out what you had paid for, or your time elapses and all that money you paid for the insurance doesn't get you anywhere. I love whole life insurance. It's more expensive, so most people don't look into it, but it's like a long-term investment. You keep paying the amount and you get to have it forever. And then if you happen to turn 100, they write you a check yourself. Your family will always get paid, whether you're 50, 60, 70, 80. Whole life is always there as long as you pay the premiums. The sooner you start the whole life insurance, the cheaper it is. So you have to think of, just like we talked about in retirement, if you start later, the compounding effect of time is shortened. You've got to put way more money away to retire at a certain age versus if you start at 18. So with kids, like, whole life insurance is the coolest product. I started it for my kids when they were 3, 5, and then my son when he was born. They're now 13, 15, and 6. It's dirt cheap. I think I pay $50 a month to have a $100,000 whole life policy on my kids. I didn't do it because I hope that they die and I get the money. That is not at all. Like, I did it because this is something when they get married, they get older, when they get a certain age or a certain responsibility or a certain place, that I can pass that on to them, and they have a level up from the other person of an investment bucket, a whole life insurance plan for their peace of mind that they got into a long time ago when it was way cheaper, because life insurance just gets more and more expensive as time, especially since COVID. The premiums have went through the roof, and they're only going to keep getting more expensive because to take care of people and inflation, it only gets more expensive. I always stress, like, these buckets, my husband had one when he was 19, 20. His parents gave it to him. All of their kids, they had it. And him and his siblings all cashed it out because they weren't mature enough. They weren't ready for it. And all that hard work their parents did for them was not worth it. So I always stress to people, like, just, you own it, and you can decide when your kids are adults if you want to give it to them, or you could keep it yourself forever because the policy is under your name. But this is something where you have death benefits, but you also have a cash value bucket that grows with time. Your kids and yourself become their own bank. I'm not a big fan of the student what are they called? The different college planning buckets that are out there that traditional financial planners have people go into, because a lot of times there's a lot of fees with inflation. You don't make that much money on them, and you've got a lot of rules of how you can use it and pull it out. And if you don't use it for that educational stuff, you get a ton of penalties if you try to use it for something else. Whole life is phenomenal because you don't know when your kids are 18, 19, 20. Are they going to go to college? Are they going to start a business? Are they going to do trade school? Whole life insurance will have a cash value bucket that will grow with time. So by the time they're 18, 19, 20, you can become the bank and don't have 20 rules to go through. They can borrow it, they collect interest on it, and instead of getting a student loan where the government or a bank or a college gets the interest rate, their cash value, their bucket gets the interest rate. You become your own bank. They want to start a business, they can present to you a business plan, and then you can give them a loan out of their own whole life insurance and pay it back. Like, there's so many amazing tools to this, and you'd be shocked to see if you start whole life insurance when they're 5, 6 years old versus starting it even at 18, 20, that extra 15, 20 years of compounding when they hit their 60s and 70s of how much of a cash value is in that bucket is crazy. So this is why I love talking to my consulting clients and talking about business education. It's not just financial freedom for you. It's financial freedom for your kids and peace of mind you have that your family is well taken care of, and all the struggles you had to get financial free aren't going to be nearly as hard for them because you're setting them up right. So I've already talked a little bit, but the guaranteed lifelong coverage, this is the big difference between term insurance and whole. Term is renting a house, whole is buying the house. So you get it forever as long as you continue paying the premiums. And they're more expensive than the term, but you're getting way more for them. So a lot of people will just pick the more affordable, or they'll do a combination. Like I have a really high term level for myself, a couple $1,000,000, because I know my value to my family if something happened to me. And then I've got a smaller whole life that I slowly can convert some of my term every couple years as money grows and things are happening. There's great programs, especially with Northwestern Mutual, where I go. I had been a financial planner for them. I don't get any commission or cut from referring, but they have some really cool grandfathered in whole life programs that nobody else can offer. So one of the financial planners we talk about, Chris Arnone, he is directly with Northwestern Mutual, and then Mandy Froelich has her own independent life financial planning company. So each one has different products and tools to give you, but lifelong protection. And I said, like if you live to be 100, they literally write you a check for your death benefits. They base it. When they do the premiums, they do the cost, they base it on your age, your risk factors, the average life expectancy, and then it's always easier to get into it before you have a health issue, before you have a problem. Kids are pretty darn healthy. They're going to be the lowest risk to screen for life insurance at that point. As they get older, you can get cancers, you can get diabetes, you can get obesity. Your age increases those chances, and more criteria is needed to get them to qualify for whole life insurance. Cash value accumulation, we already talked about that. Like, you're not just making up death benefits, but you're also accruing your own little mini investment. There's rules of how to pull it in and out, but it's pretty simple. There's no criteria like with retirements where HSAs, you have to use it for certain things, or you get extra penalties, or if you take it out too soon before 59 and a half, you get all these extra fees. It's not like that with whole life insurance policies. But I always stress to people, this is a long-term investment. It's not an instant lottery ticket. I'm not going to talk to you about anything that's a get-rich scheme. I'm talking about long-term planning. So it takes on average 5 to 7 years, depending on what plan you set up for and how much you add a little bit extra into the premium to fill the bucket. But it takes about 5 to 7 years to break even on what you've started. But it's that compounding effect of long term. When you hit 20, 30 years with these whole life policies, they've paid themselves back and then some. So I want to stress to you, like, definitely know there's different types of whole life policies out there. There's different companies that can offer different products. Like, some will take your whole life money, the cash value, and pay you a dividend from their company consistently. Some will put it in a market. So you have to really understand your whole life cash value. What is it doing? What are they doing with it? How easy is it to access? What happens if you can't pay your premiums? There's a lot of clauses in these whole life policies that if you're in a financial strains, you have a disability, you have an accident, the company will continue paying your whole life policy for you. So you just have to understand and have a really good financial planner. And especially with your kids, you want to think about, heaven forbid something happens, but these are tools for them just as much for you. So educational funding, we already talked about it. So unlike the 529 plans that a lot of people use for school in retirement, I'm just not a big fan of them. There's so many rules. Like, this is your money. You've worked so hard for it. The more that we can put it into buckets that you have autonomy over it, when you take it out, how you take it out, what you use it for, has so much more power over your financial plan than trying to put into these buckets that are very narrowed in uses. Like, I love my health savings account, but I can only use that money in my health savings account for medical expenses. I can't go do all these other things and pull it out for non-medical, or I get fees, I get taxed, I have extra penalties because you're not using it what those buckets are. So there's a lot of tax benefits, avoiding probate court. You're paying it. You should be paying those premiums with after-tax income. Don't pay out of your business, because what'll happen is when those benefits are paid out, if you didn't pay the taxes on the premium and then did that, they're going to take the taxes out of that benefit or that cash value. So always pay, don't pay with your business whole life plans, pay after tax income. It's really important because you want that money to grow tax-free. You want to be able to get the tax benefits, the cash value, all the things out of it for a tax. You don't want to say, oh, I have $1 million and then now taxes in 30 years are 70% and you've lost it all. You know what you're paying in taxes now. It's the lowest in history. Pay the monthly premiums with after-tax income, and then the buckets, the cash value, and the death benefits will come to you tax-free. Legacy creation, we talked about this with your kids and your grandkids. Like, I had so many times the best intentions, but it's the old school model, the 1960s, 70s. My kids got bought bonds when they were born from their grandparents, and sometimes some coins and commodities and things like that. They get lost. I giggle, I found bonds in the safe, and they're not worth anything. They've lost in inflation value. Like, our parents and our grandparents have the best intentions to get us financially free. They just aren't keeping up with the trends. They're trying to do the best they can. What worked in 1970s does not work anymore. And I can't predict in 10, 20 years what is going to be the new buckets, the new strategies. I'm just teaching you the newest trends of what the rich do and what the big scale buckets and tools out there that people use. So you want financial freedom. You want your kids to have opportunities that you never had, and whole life insurance one of those. You want to be financially educated, responsible. This is where I talked about, like, your kids, they can make a mini business plan for you, kind of like they have the nonprofit Lemonade where kids can start businesses and apply. You become your kids' little lemonade stand where they present a proposal to you and they get the money and then you pay it back, and you teach them about finances and giving them good ethics. They get an allowance from you. They grow money. Like, this is our job as parents, to teach them how to acclimate and be successful into society and be able to be financially free and do the things they want to do when they're older. So as a conclusion, I know I went very high level. There's a lot of ways to do this for strategizing, but I want you guys to understand the power of whole life insurance for your kids. The sooner you start it, the cheaper it is. And you don't have to get a ton. Like, I'm not saying getting $1 million on your kids. Like, look at your budgets. Everybody can put away $20, $30, $40 a month for their kids. They want to do it for college. They want to save for them. Just try not to just think the $529 typical college bucket, because they may not go to college. And like, those buckets get cornered if you don't use them for specific institutions versus the non-traditional system. You can't take them out for that. So whole life insurance is amazing. It's lifelong death benefit coverage. It's way cheaper to get them in. This is the lowest risk they're ever going to be for medical screenings. And it's something you can pass on, and it's going to give them so many opportunities with that cash value bucket, and already have a death benefit, a life insurance policy for their entire lives at the cheapest rate you can ever get them into. So this is something I love, 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 and I wish more midwives, when they were doing planning and thinking about, it's not just their retirement and their death benefits, but also how can we help our kids out better?